Hello and welcome to your May Investor Update. I'm Pacome Breton, Head of Portfolio Management at Nutmeg. In this update, I'll cover what happened in financial markets during the month of April, now that we have better perspective on it. And I will also give you an overview of how we are managing portfolios against this backdrop and our outlook for global economies and financial markets. April was a particularly volatile month. Can you tell us what's happened in financial markets? April was a month where so many things happened that it is difficult to know where to start. So of course, the major event that spooked markets was the announcement by President Trump early in the month of the infamous Liberation Day, levying tariffs on the US largest trading partners. So these tariffs were significantly higher than had been anticipated or communicated ahead of the event. Many asset classes, including equities, fixed income, and currencies, reacted very negatively to the announcement. They then started to recover after President Trump announced a 90-day pause a week later, which saw one of the best single-day gains on record for US equity markets. A second period of volatility in the latter part of the month was linked to the potential replacement of the chair of the US Federal Reserve, Jerome Powell, which was received very poorly by investors before being refuted by the US president. The main impact was on the US equity market, which nevertheless managed to recoup most of its initial losses. The S&P 500, which reflects the performance of the 500 largest companies in the US, overall ended up down 0.7% in April. That decline was led by energy and healthcare stocks, with the former particularly impacted by fears of lower growth in the US, potentially affecting the energy sector. The growth-focused Nasdaq index actually increased during the month by 1.5% in US dollar terms. In Europe and the UK, which were similarly volatile, returns for the month were largely flat. We saw a similar outcome in other regions, with only Chinese stocks down more significantly by 4.5%, impacted by the extremely high tariffs imposed on China. The bond markets have also been impacted, seemingly caught between two dynamics. Investors worried about economic growth and seeking the safe haven attributes of fixed income, with the view that central banks may need to reduce interest rates, and investors worried about inflation and their fears that banks will need to keep rates higher even in a weaker growth environment. As a result, the UK's gilt market, so similar to US Treasuries, experienced some weakness during the month, but still managed to finish April largely positive, up 1.7%. Some of Nutmeg's low-risk investors would have felt the effect of this volatility on their portfolios, but this was largely recouped by the end of the month. Then, for those of you interested in how currency risk works and why it matters to how we manage portfolios, it is worth noting that market performance can be quite different depending on which currency is used. For example, the S&P 500 was down 0.7% in US dollars, as we usually quote them in local currency terms, but looking at it from a pound perspective, so for a typical UK-based investor, it would have been down by 4%. This difference impacted our portfolios as well, as we only partially hedge currency risk, and it was particularly felt with the strength of the pound versus the US dollar. So what has this meant for portfolio positioning? As discussed in our previous updates, we had been running a small equity overweight this year, meaning we were holding modestly higher equity exposure than our long-term benchmark, on the basis of improving global growth and positive momentum in the US economy. With the level of uncertainty added by the tariff announcement, we reduced our portfolio exposure on the following trading day by selling a small amount of mostly large US companies, retaining the proceeds in cash. We think it's a prudent move in the current environment. We believe a more bearish tone would have been inappropriate in a market that was spooked by the tariff implementation and indeed rebounded strongly following the 90-day pause on many of the most severe tariff rates. And similarly, right now, it seems potentially premature to add back to riskier assets, such as equities, despite the tariff pause. Trade barriers have still been increased significantly since the turn of the year, and particularly in China, where escalation has resulted in a punitive 145% effective rate. So we expect tariff headlines to continue to dominate the news over the coming weeks, and equity markets to continue to react to that news flow. We will, though, update exposure rapidly if we perceive some improvement or deterioration in the environment. So what is the Nutmeg outlook for the US economy and global financial markets? So clearly, trade barriers such as tariffs represent a shock to economic activity, both within and outside the United States. We believe that tariffs will persist to some degree. The US administration has made this a core policy anchor. And so therefore, we expect US economic growth to be lower and inflation to be higher than our previous expectations. But against all of the negative headlines, there are also reasons for cautious optimism. The labor market is highly resilient, wages are growing in real terms, and consumption has remained strong. There is no doubt that tariffs announcements are a headwind for economic growth and consumer and business confidence. But our base case expectation is not for a US recession. We believe these positive dynamics remain in place and will be enough to keep the US economy growing. Firstly, we expect the tariff regime to evolve over the coming weeks and months. And additionally, we think earnings growth for US corporates will remain largely positive as the country relies on imports and exports far less for economic growth than many other developed markets. We continue as well to monitor portfolio performance and risk on a daily basis. So following our reduction in equity holdings in early April, as prices have recovered, we've allowed the portfolio's exposure to drift positively without rebalancing. We are looking for further opportunities to refine our exposure, which will depend on incoming macroeconomics news and market data. Thanks for watching, and for deeper analysis on April's market volatility, you can also view the replay of our recent webinar delivered to our customers by Nutmeg's Head of Investments, James McManus, and Head of Financial Advice and Guidance, Claire Exley. If you have any questions or suggestions for topics you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments section below this video.
As with all investing, your capital is at risk. The value of your portfolio with Nutmeg can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.